Hello, this is the Chapter 13 synopsis. Now, in this course, I don't go over, Chapter 13 is on bonds. In this course, I don't really go over how to calculate bond prices because of the sake of time in this class. I just typically, in this chapter, go over, you need to know the elements of a bond and bond risk and so forth, and just the various components of a bond. Also things like yield, sinking funds, the call feature, and so forth. If you're a finance major, however, well, you all should know how to calculate bond prices from Finance 302. And so if you recall, the par value of a bond, what it sells for when it's issued, is typically $1,000. So you buy a bond for $1,000, you get your interest payments over the life of the bond, and then when the bond matures, you get your principal back, your $1,000 back. So if market interest rates never change, your bond is going to stay at $1,000. However, if market interest rates change after the bond is issued, the price of the bond will change. And so that's when we get into calculating bond pricing. So if you're a finance major, you definitely need to know how to calculate the price of a bond. So if you're a little rusty on that, go back to your Finance 302 notes or look in this book to see how to calculate the price of the bond. Or when school starts again in August, since this is this is summer school class when I'm doing this video, it's on July 26th, I think, 2021. When the semester starts, feel free to stop into my office and I'll show you how to do bond pricing if you're a little bit rusty on it. So you can put it in your financial calculator, but if you're a finance major, you really need to know more than, it's fine to do it in your financial calculator, but you really need to understand what's going on. So if you think back to the time value of money, the value of a bond or the price of the bond is simply the present value of the par value or plus the present value of the interest rates. So it's basically two parts. It's the present value of a lump sum plus the present value of that annuity, which is the interest rate stream. So if you look up the formulas to find the price of the bond, you just find the present value of the $1,000 par value going back X amount of years. That's the present value of the lump sum. Then you find the present value of the dividend of the interest payments that it's making, find the present value of that, add the two together, and that's your price. That's the price of your bond. So make sure that you, as I mentioned, if you're a finance major, make sure you understand the mechanics of bond pricing and be able to calculate it using the formulas, and then also using using your financial calculator is fine as well. So the other thing to be cognizant of is, remember when we think about discounting, when we're calculating the present value of something, the further back we go, the smaller, the steeper the discount is, or the further back in time you go, the lower the money, the lower the value, the lower the present value is. So if you have, if you have a bond that is going to mature in 20 years, the price is going to be less than if that bond matures, say, in 10 years or 5 years. And so the further out you're going, when you're discounting it back, the more years you have, the lower that price is going to be. All right. So anyway, just to repeat, excuse me, just to sum up, if you're a finance major, make sure you look at this chapter about bond pricing and know how to calculate bond prices. If you're rusty on it, come see me, or text me or give me a call, email me, and I can show you that, because I don't really focus on it in this chapter, in this course. Okay, so the bond market. So we've talked about stocks all the way through this course, but there's also bonds. You can also invest in bonds if you don't want the risk of investing in the stock market, where the prices are very volatile, as you've probably seen with your portfolio in the contest. You can invest in bonds, and you can't you don't have the opportunity to make as much money in bonds as you would possibly in stocks, but it's a lot less risk. So the way bonds work is you purchase a bond, and then you get these interest payments that are set at whatever the interest rate is. And so you're going to get these interest payments either paid once a year, or you'll get half the amount paid twice a year. They're mainly paid twice a year. And then at the end, when the bond matures, you get your principal back. So some people like to buy bonds in order to have less risk, especially as people get older. They don't want the riskiness of a market downturn. So they might have a 50-50 portfolio, 50% in stock, 50% in bonds to reduce the risk down, or a higher percentage in bonds. The interest is we have to pay taxes on the interest unless it's a municipal bond. A municipal bond is a bond that is issued by a nonprofit organization, state and local governments, or nonprofit government agencies, or nonprofits like hospitals and so forth. And we do not have to pay federal taxes on the interest. So if you're in a high tax bracket, it can be advantageous to buy these municipal bonds. All right, what else? So as I mentioned, the other thing I was going to mention, as people get older, they want to take some risk off in their portfolios as they near retirement, and so they may purchase more they may increase the percentage of bonds in their portfolio. Now, how can you invest in bonds? Well, you don't have to go buy individual bonds. You can buy mutual funds or exchange traded funds that have a basket of bonds. Most people I know don't go out and buy individual bonds. They'll just buy a bond mutual fund or a bond ETF. And so you can research those if you're interested. But at this point in your life, I think being 100% in the stock market and an investment account is perfectly fine. You don't need to worry about risk because time is on your side. Okay, so let's look more at these slides here. So basically what you need to do for this chapter is just go through the chapter, read the chapter and read all the terms, be familiar with terms, definitions, and so forth. So I'm going to go through, I'm not going to go through all of these. I expect you to read these on your own, but I'm just going to point out some key ones. So what are the general features of bonds? Well, the coupon rate is the stated rate of interest that the bond is going to pay. That doesn't change. That's how you figure out what the payment is. So if you have $1,000 coupon bond and the coupon rate is 10%, then $1,000 times 10% is $100. It's going to pay $100. The interest is going to be $100 a year or $50 every 6 months. The principal is what the bond cost. Typically the par value is typically $1,000, as I mentioned. They're sold in $1,000 increments, so that would be the principal. So if you bought a $1,000 par value bond when it was issued and it was paying you 10%, you would get the $100 a year or $50 every 6 months. Then at the end of 10 years, you get your $1,000 back. If the interest rates go down while you're holding this bond, then the bond price is going to go up. It's going to sell at a premium. Conversely, now you're going to still get your same coupon rate, your same interest payment. The coupon rate doesn't change, but the price of the bond is going to change if market interest rates change. So just to sum that up, then it's an inverse relationship. After the issuance, if interest rates decrease, the bond price is going to go up. Conversely, if interest rates increase after the issuance, then the bond price is going to go down. The maturity date is when the bond matures and they give you back your principal. All right, so those are the main things I wanted to talk about there. Okay, so you have, when you have a bond, what you're making on the bond, your rate of return, that's your yield to maturity. And so if you look at the bond, if you bought a bond for a certain price and it's a $1,000 par value bond, but you bought it for a specific price, if you calculate the interest rate, I-Y, in your financial calculator, that will give you the yield to maturity. And so, for example, if we go back here, if the interest rates never change, and you bought this $1,000 bond, it's a 10% bond, your yield to maturity is 10%. That's not going to change unless the market interest rate changes. If the market interest rates change, then your yield to maturity is going to change. Okay, so you can calculate the yield to maturity. That's the overall rate of return you're getting on the bond. There's two components to the yield to maturity, the current yield and the capital gains yield. The current yield is simply telling us how much are we making per year on this bond. That's simply the annual interest payment divided by the price. So if you take what your annual interest payment is and divide it by what you paid for the bond, that's your current yield. That's what you're making every year off of the interest. And then the capital gains yield, which they don't have this on the slide, but there's two components to the yield to maturity, current yield plus the capital gains yield. The capital gains yield is the annual change in the price. So for example, if you bought, let's say you paid $920 for a bond, par value is $1,000. Well, when that bond matures, you're going to get $1,000 back, but you only paid $920 for it. So that difference, the annual increase, the annual return on that is the capital gains yield. And so basically, if you calculate the yield to maturity and calculate the current yield, there's a shortcut where you can just take the difference between the two to get your capital gains yield. So anyway, you're not going to have any math in this chapter. As I mentioned, I just wanted you to understand what the yield to maturity is and what the current yield and the capital gains yield is. Likewise, if you paid, let's say you paid $1,050 for a bond, selling at a premium, you paid $1,050, and then you're going to get $1,000 back at the end. Your capital gains yield then is actually going to be negative because you paid $1,050, but you're only getting $1,000 back. Okay, so what people do, they will typically with government bonds, they will create these yield curves. So the yield curve is just showing us what bonds make over time. Let's look at the chart on the next page. These are treasuries. These are U.S. treasuries in March 2012. This is in April 2004. This is showing what government bonds were paying. And so a 3-month bond was paying 0.03% in 2012, almost 1% in 2004. Interest rates are a lot lower now, obviously, or were in 2012 versus 2004. So this is just showing you, if you bought a 10-year bond in 2012, that's the rate it was paying. If you bought a 10-year bond in 2004, you were getting this. So these yield curves just show you what these bonds are paying over time. And so you see that a bond, the further out in time you go, if you buy a bond that has a longer maturity, you're going to get a higher interest rate. That's really for two reasons. Because what we call a maturity risk premium, there's more risk, even though these bonds, I mean, the government's not going to default on these bonds, but the further out you go in time, there's just more uncertainty. And so you tend to get a little higher return the further out you go. It's called a maturity risk premium. And then also inflation premium. The inflation premium, inflation is really low right now, but in 2012, it was very low. But as you go out in time, they expect a small increase in inflation, and that's what causes the yields to go higher over time. So typically, your normal yield curve is upward sloping. It's called a normal yield curve. It's upward sloping. They're almost always upward sloping because of the because of the inflation premium is slightly positive over time, and the maturity risk premium. So you see these upward sloping yield curves. Now you can get these negative sloped yield curves. This happened in the 1980s. So let's look at this. This is 1981. We had this negatively sloped yield curve. So let's see, a 1-year bond was paying 14.7%. This is a government bond paying almost 15% in 1981. But a 40-year bond was only paying 12.9%. It's negatively sloped. So during times of really high inflation, this is what was going on here. The inflation was double digits. So you might say, well, man, this is awesome. You can get 15% on a government bond. But keep in mind during the early 80s, inflation was around 18%. So you're still not any better off. I mean, it's all relative. You still really weren't keeping up with inflation. So anyway, we had really high inflation in the 1980s, and that's why these yields are way up. But they didn't expect inflation to stay that high. So that's why you have this negatively sloped yield curve. So during periods of high inflation, you can see these negatively sloped yield curves. Okay, so what are the risks to bondholders? Okay, they talk about several different things in the chapter here, but I wanted to focus on the two main risks that bondholders have. Of course, there's risk of default, but of course, with a government bond, you're not worried about that. With a corporate bond, you could possibly, if the company goes bankrupt, they could default on their bonds. Well, they would if they went bankrupt. But the two main types of risk that I wanted to talk about are reinvestment rate risk and something called price risk. Okay, so let me talk about this first. Reinvestment risk is the risk if when interest rates go down, when your bonds mature, you've got money that you have to reinvest. Hopefully, and presumably you want to reinvest that money in new bonds, and you're going to get, your new bonds are going to have a lower interest rate. So it's going to reduce your income. So a lot of people, of course, most people buy bonds for the income. They want that annual interest payment. A lot of retired people really rely on that interest income. So let's say that you bought bonds, I don't know, let's say somebody bought bonds 30 years ago when interest rates were very high, and they have a 10% bond. And it's let's say they bought it in 1991 and it's maturing now, and it's a 10% bond. And now they can reinvest that, but the best interest rate they can find is 5%. Well, that's an example of reinvestment rate risk. Interest rates have gone down, and now the existing bonds have matured. You've got to reinvest, and it's at a lower interest rate. And so reinvestment rate risk is just the risk of having less interest income as interest rates are going down. Also, when you're in a situation where interest rates are declining, your bonds can be called in early. The companies won't wait until the bonds mature. They'll call them in early because they can issue new bonds at a lower rate. And so that, again, is reinvestment rate risk. So anytime you have a situation with interest rates declining, you have this issue of reinvestment rate risk. The opposite, what's the risk that's associated when interest rates are increasing? Well, right now we're in that situation. Interest rates are pretty low, record low. We're worried about them increasing, and they are most likely going to be increasing slowly. We're already seeing that. Well, when interest rates increase, bond prices go down. That's price risk. So that's the risk of your bond price going down when you're in a situation with rising interest rates. Now, throughout this course, and when I was talking to you a little bit about mutual funds and stocks and so forth, I didn't really talk about bonds. You might be wondering why. I don't particularly care to invest in bonds. I don't like to have them in my portfolio. I would prefer to try to diversify my portfolio a little bit and take some risk off. I like to invest in REITs, those real estate investment trusts. That REITs are not as volatile as the market, but they make you more money in the long run than bonds would. And this is the other reason I don't like bonds, is because of the price risk. Because I mean, I'm not interested in income right now, but if I were to go into my retirement plan, in order to diversify it, I like to invest in REITs versus, say, bonds, because the situation we have right now is rising interest rates. So the prices of these bonds are going down, and that kind of makes them out of favor. And fewer people are investing in these bond mutual funds. And so the price of your mutual fund can go down. So anyway, just to recap, reinvestment rate risk, that's a problem when interest rates are going down. You're reinvesting and you're making less money. Price risk is a problem when interest rates are going up. And that price risk means when you're in an environment of rising interest rates, the bond prices go down. Okay, so those are the main, and then of course there's default risk, that's obvious. Those are the main things I wanted to talk about regarding risk. Okay, these bonds are rated. So of course government bonds are grade AAA to AA. The US, the last time I saw, the government bonds had a AAA rating. Now, when we had that whole mortgage meltdown, the whole financial crisis, it was a really interesting because Moody's and Standard & Poor's, these are two of the rating agencies, they actually downgraded US government bonds down to like a AA. So it was a big deal and the markets went down. And but anyway, it was, of course, the government's not going to default on their bonds. So the ratings don't really pertain to government bonds, even though they are rated. These ratings pertain to corporate bonds. So if you're buying, if you're going to buy bonds from a company or invest in a mutual fund that invests in bonds, you need to decide whether you want to buy investment grade bonds or what we call high yield bonds. So investment grade bonds, those have a rating of BBB or better. So the ratings typically, it depends on the company, but the ratings are typically AA, AAA, AA, single A, triple B, double B, single B, triple C, and so forth on down. So if you have a BBB or better, that's considered an investment grade bond. That means it's a bond with from a really stable company, very small chance of default. So let me think of some examples. Walmart, ExxonMobil, Johnson & Johnson, companies that are very, very solid would be investment grade bonds. IBM would be another example, probably. Apple would be another example. So Amazon, so very stable blue chip type companies would have these investment grade bonds. Now, a bond that is, say, a double B or a single B or a high C, those are considered high yield bonds. This is just a nicer way of saying junk bonds. They used to be called junk bonds. Doesn't mean it's not a good investment now. It just means that the companies that are issuing these bonds, that have the companies with these non-investment grade ratings, they're riskier companies. Therefore, you're going to get a higher interest rate, but there's a higher default risk. So let me think of some companies. Probably maybe Zoom or might be non-investment grade. Let me think. Confluent, that's a new company that just had an IPO. They might be non-investment grade. Oatly, that's that oat milk company I might have talked about in a prior Zoom video. Oatly just had an IPO. They're probably non-investment grade. Oh, probably the pot stocks would be non-investment grade. So you see what I'm getting at. Companies that are new or in very risky environments would have non-investment grade type ratings. Sometimes really, really large companies can have their bonds downgraded. For example, Ford has had their bonds downgraded twice to basically to high yield status, and then they've come back again. But if they fall on hard times or the profits are down, the time before last when Ford was downgraded, it was because gas was really high. This was like around Katrina, 2005, 2006. I just remember gas was around $3 or so or more a gallon, and they basically Ford failed to consider the fact that people were going to want to buy cars that had better gas mileage. They just kept making vans and minivans and trucks and so forth. And so they were downgraded. And it's a problem for companies if they're downgraded, because it's a problem to turn things around, because if your bonds are downgraded, then when you have to issue new debt, you have to pay a higher rate of return, higher interest rate. So it makes their cost of capital more expensive when their bonds are downgraded. But anyway, Ford got out of that, and I think they were downgraded again once more. But I mean, Ford isn't anywhere near going bankrupt. The point is, if these ratings companies see that their environment is getting riskier, they might downgrade them. Okay, so anyway, how would you invest in these bonds if you wanted to? Well, as I mentioned, mutual funds or ETFs are the best way, in my opinion. I don't see the point of buying individual bonds. Now, these high yield bonds can really be a pretty good investment sometimes. There's been some years where these high yield bond funds have outperformed the market, done better than most of the bonds, of course, because they pay a higher interest rate, but they've also outperformed stocks. So if I was going to invest in bonds, I would probably look at an ETF or a mutual fund that invested in these high yield bonds, and I'm talking about maybe less than 5% of the portfolio, but just if you want to have some exposure to bonds, maybe buy some investment grade, but also buy some high yield. So you could put some money in a high yield ETF and some money in an investment grade ETF, bond ETF. Anyway, so high yield, just to sum up, that's bonds that have a lower rating. They're also called junk bonds. The politically correct term now is high yield bonds, but it just means that they have a higher chance of default. They're a little bit riskier, but as a result of that, you're going to be rewarded by with a higher interest rate. So the way I see it is, I wouldn't try to buy these high yield bonds individually. Again, I would buy a high yield mutual fund or ETF to try to diversify my bond exposure. Okay, so enough of that. Ratings do change over time. They can be upgraded and downgraded, as I mentioned. Okay, these are just, that's just what when they were actually using paper confirmation statements, if you bought a bond, that's what it would look like. You can skip that. All right, and then just make sure you look at the variety, the different types of corporate bonds. So we have mortgage bonds. Those are bonds that are typically backed by real property. So if you can buy bonds from these companies that have some collateral and some that don't. So if you bought bonds from a company and the bonds were actually backed by their property, their real estate that they owned, then that would be a mortgage bond. It just means that there's some collateral there. Debentures are bonds that are backed by some type of collateral, like say a boat company issues bonds and they put their boats up as collateral. And that just means it's less risk for you, because if they default on their bonds, then you could sell what they're putting up as collateral. So they have debentures, means there's some kind of collateral. And then there's also subordinated debentures, which would be second in line versus a bond that just has no collateral at all. All right. I wanted to talk about zero coupon bonds. Well, first off, convertible bonds are bonds that you can convert to stock in the future. Some bonds have a variable interest rate. Typically, some of these government bonds that you can buy have a variable interest rate. So if inflation goes up, the bonds will pay more. It makes them more attractive. Savings bonds have that. So you probably all have some savings bonds lying around. Maybe your family, your relatives gave you savings bonds as a kid. A savings bond is a classic example of a zero coupon bond. If you buy a $50 savings bond, it's only going to cost you $25. When it matures, it'll be worth the $50. So these savings bonds don't make annual interest payments. They're zero coupon. So a zero coupon bond is a bond that doesn't make interest payments. It's just heavily discounted when you purchase it. And then the gain, the capital gain is a lot more. So getting back to my savings bond example, if you bought a $100 savings bond, it would only cost you $50. At the maturity, then it would be worth $100. If you save the bond, if you keep the bond, a savings bond past its maturity, it continues to earn interest. If you have any savings bonds lying around, or ask your folks if you have any, I would suggest cashing them in while you're in school, because you can, frankly, as you know, you can make more money in the stock market in the long run. And while you're in school, you will not have to pay taxes on the bond interest. So definitely cash them in while you're in school. And then it'll just, when you fill out your tax return, they'll just ask you, did you use the bond interest towards school expenses? And you just use that towards some school expenses, and you can say yes, and you don't have to pay taxes on the interest. All right. We talked about the high yield bonds. Okay. Some companies have what's called a sinking fund. Let me just talk about this real quickly. So let's say that a company issued $1 million in bonds over 10 years, $1 million 10-year bonds. And so at the end of 10 years, they're going to have to pay back that $1 million. Well, some companies, they don't want to pay back the bonds all at once. It's just too much of a financial hardship. So they'll have this sinking fund. Well, they'll save a certain amount of money in the sinking fund so that they can pay the bonds off a various percentage each year. So let's say that this company that issued these $1 million bonds over maturity in 10 years, they said, okay, well, we want to pay that. We're going to have this sinking fund where we're going to save $100,000 a year, and we're going to pay off 100,000. We're going to call in $100,000 of these bonds and retire them each year. That way, we're paying $100,000 a year over 10 years versus $1 million at the end of the 10 years. Investors don't really mind this because it's a lot less risky for the company to pay these bonds off incrementally. So that's what a sinking fund is. They're just saving to pay off, to retire these bonds incrementally. Now, the last thing I want to talk about is a call feature. I mentioned this earlier. So if some bonds have a call feature, the bonds can be called in. Usually, like let's say a company issues a 20-year bond and it has a call feature where they can call the bond in after 5 years. If they call the bond in, they're going to give you a $50 premium. And so in other words, if it's a $1,000 par value bond and they call it in early, they're going to give you $1,050. So the reason they do this is because they want to protect themselves if interest rates go down. So think about this. You're a company, let's say you issued 30-year bonds at, you're paying 8% on these bonds. So you issued these 30-year bonds, you're paying 8%. Now it's 2021, the market interest rate is down to, on corporate bonds, is down to say 5%. And so you're thinking, well, it makes no sense to continue to pay 8% on these bonds when we can call these bonds in, issue new bonds at 5%. So that's precisely what a call feature is. So if you're in a situation, if you're holding all these bonds and you're in a situation with decreasing interest rates, you can bet that some of these bonds are going to be called in. And then you're facing the problem of reinvestment rate risk, because you're going to have to reinvest that money and you're not going to be making as much. They're going to be at lower interest rates. But anyway, the call feature gives companies the option to call bonds in, and they typically will do this if interest rates go down. Okay, that's it. So this was short and sweet, just to kind of give you an overview of bonds. And as I mentioned, if make sure that you know how to calculate bond prices as well, although I'm not going to hold you to that in this class. You still need to know how to do that. It should be a review from Finance 302. If you're a finance major and you've forgotten that, come see me or contact me and I'll go over that with you on one-on-one. All right, take care. Till next time.